What if I told you that you will almost never catch the exact top in a stock like NVIDIA, but that you do not need to? The big wins and the big disasters almost never come from nailing one perfect sell candle. They come from reading the phase the stock is in. Is this still powerful leadership? Or are we quietly shifting into the topping phase where expectations are way ahead of reality? That is what we are going to do in this video. No crystal ball, no magic indicator, just a practical checklist so you can see the character change early, especially in names like NVIDIA. Quick disclaimer before we go any further, this is education, not financial advice. Make your own decisions. Here is the key mindset. A top is usually not one dramatic moment. It is a process. The market pushes higher, it gets a little exhausted, it pushes again, and somewhere along the way the story starts to wobble. Sometimes that wobble lasts months. Sometimes it is a fast shakeout and then a major break. So instead of hunting for that one magical signal, we want a cluster of small clues that together tell you this leader is not acting like it used to. The first clue is relative strength. Strong leaders outrun the index. They make higher highs, they bounce hard out of every dip, and you can almost feel buyers underneath the price. When that phase starts to fade, the stock stops outperforming. It might still be green, but the index is greener. Or the index goes sideways while the leader slowly leaks lower. That is very quiet. There is no headline, but it is a real message. Big money is trimming exposure before the story cracks in public. The second clue is breadth. When a leader is in charge, it tends to drag other names along with it. The theme widens, more and more stocks join the move, and it feels like an entire group is trending. When things get tired, that dynamic flips. The leader keeps making new highs while fewer stocks in the group participate. Or the leader stalls while other sectors suddenly get all the love. If breadth is improving, but your leader is soft, that may be rotation. If breadth is deteriorating and the leader is soft at the same time, that is more like the whole risk-on regime losing steam. Third, watch the behavior of volatility. In a strong uptrend, leaders are weirdly calm compared with how crazy the story sounds. Down days are controlled and up days are clean. In a topping process, that flips. You start to see big, sloppy red days and weak, choppy bounces. Option-implied volatility can creep higher and just sit there, which is another way of saying people are quietly paying up for insurance. Fourth, reactions to good news. This is one of my favorite tells. In a strong phase, the leader rips on good news and shrugs at bad news. In a topping phase, you get the opposite. Amazing earnings, great guidance, and the stock gaps up, then bleeds all day. Or it goes red by the close. The message is simple. Expectations were even higher than the great numbers on the screen. That is not the market saying the business is bad. It is the market saying the price already assumed perfection. Fifth, listen for cracks in the narrative. Leaders do not just have fundamentals, they have a story. When the story is tight, every headline is interpreted as bullish. Skeptics sound silly, and risks are known but basically ignored. When a top is forming, the conversation changes. Suddenly, there are serious debates about whether demand is sustainable, whether growth is front-loaded, and whether capital expenditure can keep running this hot. In the NiftyFifty era, people shifted from asking, "Are these world-class companies?" to asking how much is too much to pay, even for a world-class company. That subtle change in the way people talk is often the beginning of the end of that easy, effortless uptrend. Sixth, pay attention to the technical personality. Leaders trend cleanly, with higher highs, higher lows, and breakouts that stick. When the personality shifts, you see failed breakouts and lower highs. The stock tries to clear resistance a few times and just gets smacked back, especially on heavy volume. Rallies get messy and undecided, You do not need 1,000 lines on the chart to see that. You just need to be honest about when a smooth trend has turned into a choppy fight. Seventh, look at earnings revisions and the tone of guidance. Models move money. When analysts keep revising numbers upward, crowded leaders can stay levitating longer than you expect. When revisions flatten out, the stock suddenly becomes hypersensitive to any little disappointment. When revisions tick down, even slightly, you can see sharp repricing because the market was paying for acceleration, not just high growth. Once that acceleration story fades, the multiple can compress hard. Now let us talk about NVIDIA specifically, without pretending we can call the exact turning point. In the AI era, NVIDIA has been a textbook leader. Massive relative strength, clean trends, a story everybody knows. So step one is simple. Keep a running eye on that relative strength versus the S&P 500. If NVIDIA starts lagging the index for a while instead of leading it, that is a yellow flag. Not a crash call, just a sign that big money is less aggressive. Next, watch how it trades around earnings. If NVIDIA delivers outrageous numbers and the stock cannot build on the move or even finishes red, that tells you expectations are stretched to the max. Also watch breadth and theme proxies. If the whole market is weakening while NVIDIA is weakening, that is a broader risk-off message. If AI-related infrastructure names and key customers start rolling over together, or if management teams begin to talk more about optimizing capital expenditures instead of building at any cost, that can mark a shift from the hyper-growth phase into a more normal prove-it phase. The technology can still be incredible while the stock goes through a painful repricing. One big warning with all of this. Topping signals can fake you out. A leader can look tired, shake out weak hands, and then rip to new highs. That is why the goal is not to be the hero who tries to call the exact time. The real goal is to adjust your confidence. When only one signal is flashing, maybe you just keep an eye on it. When 3 or 4 of these clues start lining up at the same time, you stop treating the stock like a one-decision hold forever. You size your risk, like the regime might be changing. That is exactly what the NiftyFifty chapter in market history teaches. A lot of investors did not blow up because they missed the exact peak. They got hurt because they stayed 100% convinced through a long, grinding repricing. The businesses stayed good. The stocks followed expectations, and expectations slowly bled out. So here's a simple weekly routine you can literally steal. Check relative strength versus the index. Check market breadth and how equal weight is doing. Watch reactions to earnings and guidance. Note how volatility behaves on down days versus up days. And listen for changes in the narrative, from demand is infinite to demand is normalizing. If you are running through that checklist once a week on your favorite leaders, you are ahead of most people who only wake up when the chart already looks like a disaster. And here's one bonus signal I think is massively underrated: positioning. You can often feel it without a fancy data feed. When every podcast, every newsletter, and every friend at dinner owns the same leader, the marginal new buyer is gone. Suddenly, dips do not get bought instantly. Rallies feel forced. The stock needs bigger and bigger news just to hold the same level. Nothing about the core business changed overnight. The ownership map is just saturated. In the NiftyFifty era, saturation took the form of every respectable portfolio owning these names. In modern markets, it can show up through ETF flows, options activity, and a social media consensus that hardens around one ticker. If you start to feel that saturation, and you see several of the other signals we talked about line up at the same time, that is your cue. Not to panic, but to respect the idea that the easy leadership phase might be over, even while the story still sounds perfect. Your job is not to win arguments on the internet. Your job is to survive the cycle and be around for the next great opportunity.